Welcome back to the third episode of the Money Smarts for Kids podcast, where you can learn money skills for life. I'm your co-host, Gabriel Nagel, with the 2022 Youth Advisory Board.
Hey, I'm your other co-host, Hannah Reyes. Throughout this podcast series, sponsored by Young American Center for Financial Education, you'll get to learn about exciting topics from how to start your own business to investing. This podcast is made by kids for kids.
Last episode, we spoke with two young entrepreneurs, Garrett and Spencer, and we learned how they started their own business. We also spoke to Anna Lear, the Vice President of Youth Biz at Young American Center for Financial Education.
Today, we're going to be going over the types of investments, we're going to interview some teen investors, and have a quick Q&A session.
I'm Matthew, and I'm going to be covering cryptocurrency. It's commonly recognized as the currency of the future. It's a decentralized digital currency that you can buy and sell. It's not stabilized by government like other commonly controlled government currencies like the American dollar or the British pound, so their value can vary greatly, which leads to higher risk and higher reward on investments. Certain online stores and websites are actually beginning to accept different cryptocurrencies as alternative forms of payment, and you can sell and exchange them directly. Some common cryptocurrencies are Bitcoin and Ethereum. The way cryptocurrency works is you have a limited supply of coins, and each coin has a certain value. Bitcoin is valued at $20,000 per coin, which is the value of the coin, but you can own different portions and different fractions of that coin. If the demand is higher than the supply of the coin, the value goes up, similar to how inflation works. And due to it being a currency not controlled by government, there's a lot higher risk and reward with that, and it's more volatile than, say, for example, the Mexican peso. Now I'm going to pass it over to Oliver to talk about real estate.
Hi, I'm Oliver, and today I'm going to be talking to you about real estate investments. This can mean purchasing a house that you will use to flip and put money into it and then sell it for higher than you bought it for, or renting out this property to make a profit and grow your net worth. On the larger scale, some investors will buy real estate land, which they will then sell to a company or develop themselves and build things like multifamily properties, hotels, malls, whatever available to put into that land to make profit. And then finally, sometimes a corporation or another company will buy real estate to then use to impact their company in a positive manner while utilizing that real estate available. Now we're going to be handing it over to Chris, who's going to talk to us about some equities.
Equity securities are designed to build equity for a company or capital and build equity for the investor. By investing in a company, the company is allowed to use that capital to grow their operations and become more profitable, demonstrating to the public they're a profitable company to invest in. And as your stock price fluctuates with more investors, you grow your net worth when you sell that stock and make a capital gain. Now, initially, the stock price is not determined by supply and demand, but by the company's revenues, income, expenses that investment bankers analyze. After investment bankers turn this company from private to public, investors like yourself or me are allowed to invest in this company. While big investors own a lot of shares of these companies, anyone can invest into these companies as well. Shares never run out because if a lot of people are buying a lot of shares, companies will eventually split the amount of shares that they have, giving an investor like myself who previously had one share 2 shares of half the price. Now, some common companies that have stocks are Apple and Google, Tesla, and these companies are displayed on major indexes of the US. Now, indexes are economic indicators of the performance of the top 500 or maybe just technology stocks in the US that take out the average of these returns to demonstrate how the US is doing economically and how financial markets are doing. People can invest in exchange-traded funds, which are basically funds with proportional shares of stocks to these indexes to grow their wealth at a constant and less volatile rate, as these indexes are known to grow at an average about 8% with regards to the S&P 500. Now, some companies, let's say Apple, who has less volatile growth with their stock, will commonly offer dividends to their investors. These dividends are just payments, typically annually or quarterly. Now, a portion of the company's profit is paid to these shareholders. And for example, Apple will offer 10 cents per share. So if I had 2 shares of an Apple stock, I would collect 20 cents per year without regard to their capital gain. So no matter what Apple's stock price turns out to be, I can still collect this 20 cents. Now, there are a couple of different ways to invest in equity securities, whether this is long-term, day trading, shorting, which is not usually recommended to younger people or kids, and options trading. Now, the most common way to invest, in my opinion, the best way is long-term investing, where let's say I would put $100 into Apple and hope that over time, maybe 10 to 15 years, this could potentially turn into $1,000. Now, many people have started engaging in day trading, which is the trading of equities to make a small profit throughout the day consistently. Now, day trading takes up a lot of time and a lot of study and is very risky. So many kids who have to go to school cannot participate. Shorting a stock is where, let's say, I would bet that a stock is going to go down in value. So then I would borrow a stock, sell that borrowed stock to a third party, collect that money, and then I would have to pay back that borrowed money when the stock falls to a smaller price so that I would make a difference in that margin. Options trading would be, let's say I wanted to buy a stock and it looked bullish to me, or I thought that it would go up in value, but I could not afford to buy that stock at that moment. If I knew the stock was going to maybe drop to possibly $115 eventually, I could buy a contract and put a down payment on there to have the ability to buy that stock at that time. And if the stock never hits that, the only risk is that I lose the money I put down on that contract.
So you said something about bullish. What does that mean?
Right. Bullish means that a stock's outlook in the future is going to be up and the stock may increase in value. And bearish is the opposite, where the stock may decrease in value. Usually, using indicators based off a company's annual returns or quarterly returns, people will determine if a stock looks bullish or bearish. All right, now I'm going to pass it back over to Oliver, who's going to talk about our last type of investment, a debt instrument.
Thanks, Krish. So yeah, basically what a debt instrument is it's a bond or a mutual fund that a company, like a corporate firm or a government agency, will issue, allowing the investor to buy into that bond and get a certain amount of money over a period of time. It's considered to be a debt instrument because a company will issue this bond and then they will get a large sum of money to fix immediate needs within the company. In turn, there will be a certain percentage which they pay back to the investor, either maturing annually or semi-annually, which that would be over a year or half a year. And then they pay these back. And then over time, they will eventually pay back the whole loan and then they'll make that interest on the loan. It's very good in terms of if a company is in some sort of financial crisis or they need to add a new part to the company immediately, they will be able to issue this bond and get all of that money right away. And then there's also low risk for the investor. The investor will receive the money back in a percentage no matter how the market changes or if the stock market crashes or if it increases drastically. There will always be the same amount of money being paid back on that bond. Then eventually over 5 years, 10 years, 20 years, however long it takes for the bond to mature, they will receive money back. Moving on, mutual funds are also another type of debt instrument. Mutual fund is basically a basket of many stocks that's controlled by a fund manager. Like Chris mentioned a little bit earlier, you can invest in a mutual fund, which is some sort of an equity, but also a debt instrument because you will have the ability to invest in more than one stock. And in turn, if the market does really well, you'll be able to get a lot of money back. You'll be benefiting on more than just one stock. You can be benefiting on 5 stocks, 10 stocks, even up to 100 stocks.
So Oliver, what's the difference between a mutual fund and a bond?
Yeah, so a mutual fund, it's when an investor invests in a lot of stocks. And so this is going to be a little bit different because you're not getting paid a certain amount annually. It's more just you're following the market, but it gives you the ability to invest in more than one stock at a time. Whereas a bond is you buy into a bond and you're giving a lot of money to that corporation or that government agency at once. But then, like I said, either every 6 months or every year or however long it takes for this bond to mature and pay out, you'll be getting a certain amount of percent of the original bond over time. And then say the bond matures in 20 years. At that 20 years, they will pay back that bond. So an example of this would be a government agency or corporation could issue $1 million bond. Investor could buy this bond for $1 million and then it can mature over 20 years at 3%. And this means that based off of the structure of that bond, either every 6 months or every year, they'll get 3% of that bond over the course of 20 years. And then after the 20 years, that corporation or government agency will actually pay them the $1 million back. They'll make the $1 million back on their original investment, plus all the interest that has been paid either every 6 months or every year.
Thanks so much for sharing a little bit about investments. But we're curious. Matt, Oliver, and Krish, what are you investing in?
Yeah, thanks, Gabe. So basically what I invest in is safe stocks right now because I'm looking to invest in stocks that will give me a positive return in the long run. So I invest in stocks like Amazon, Apple, and Tesla, which I'm hoping are going to have secure return rates over the next 10, 15, 20 years so that in my future, these stocks will really come back to me in a positive way.
Similar to Oliver, I'm also long investing in a lot of these top performing or popular stocks just because I know the public will follow common stocks, increasing the price of them. What I also invest in are exchange traded funds. As I mentioned earlier, where I can steadily increase my net worth and wealth over a pretty average return rate per year, typically 8%. And I usually invest in ETFs tracking the S&P 500 because it's a pretty large economic indicator. I would also recommend the Dow Jones Industrial.
Fun fact, the stock market has been around for over 400 years.
Here are some things you should continue to learn about and look at in the future, but should probably avoid right now. Cryptocurrencies, I would recommend avoiding because of the uncertainty of their future and the high volatility in value of the currency. I'd also avoid investing in commodities due to the high level of experience needed to master and generate a large amount of wealth. And on a final note, just to reiterate what Christian Oliver said, I'd recommend doing long-term investments instead of day trading.
Now, let's jump into some commonly asked questions. To start off, how do I start investing?
Well, Gabe, there's a couple ways to start doing this. First one, which I personally started and which I recommend, is seeking out if your parents have an investment account. Now, most of the firms or brokerage firms that they use do offer custodial accounts via your parents' brokerage account. This means that your parents' brokerage account will be linked to an account in your name where you can invest into stocks and other equity securities. Now, you won't be able to invest in cryptocurrency, real estate, and not that many debt instruments. Also, the amount of trading is limited on these custodial accounts. You won't be able to purchase options contracts. You won't be able to short a stock. And you're typically only limited to long investing, which is all right because it's the safest and, in my opinion, the best way to grow your long-term wealth. In addition, if your parents do not have an investment account, if you already have a stable source of income in which your employer has asked you to fill out a W-2 and you are getting taxed by the government, you can open up a Roth IRA account. With a Roth IRA, you are able to invest in equity securities, and then as you grow older, you can keep these securities into that account without selling them off to make a capital gains. But when you do make a capital gains, it's kind of a tax haven and you will be taxed less as an older person.
My next question is, can I invest if I'm under 18?
Yeah, so thanks, Hannah. Adding on a bit to what Chris said earlier, the best way to invest if you're under 18 is to start a custodial account. Technically, it is illegal to invest if you're not over 18. But if you're under 18, you can add on to your parents' brokerage account and be able to trade on usually the S&P 500. On a custodial account, it will be supervised by your legal guardian, and it will take a little bit longer to lock in those trades. So if you do want to trade, on most accounts, you will have to get that trade approved, and then it will take 3 to 5 days to go through the bank or the commission which you are working on and to actually get approved and have your money invested into the market. Also, like Chris mentioned, you can start a Roth IRA if you have a job and are getting taxed from your job. This entails putting off your taxes until you are older or until you retire and having the ability to invest it in things like ETFs, which will actually allow you to make interest on your tax dollars in this Roth IRA account. So then when you're older, you can pay all of your tax debt and also have available money to be able to retire with.
That's some great advice, Oliver. Thanks so much. Next up, how can I invest if I don't have a lot of money?
If you don't have a lot of money, I'd recommend breaking up your paycheck into spending and saving and investment money. With the investment money, I'd recommend first paying off debt and worrying about securing your capital before growing it. And once that's done, then you can focus on more long-term investments. You don't want to go risky if you don't have a ton of money to work with.
Now, we have a quick bonus question to figure out what kind of risk taker you are. So, you have the opportunity to enter a raffle and win up to $2,000 in prizes. Each ticket only costs $2. What would you do? A, buy as many tickets as you possibly can and as fast as you can. B, don't buy any tickets because you feel like there's no way you could really win. Or C, buy just a few raffle tickets for fun. Winning would be a bonus.
Yeah, thanks, Gabe. So I think what I would do is probably just buy a couple of tickets and then hope to win, because as a child, that would be financially smart for me because I don't have a ton of money to be able to buy hundreds of dollars worth of $2 tickets. And then, so it won't be financially irresponsible for me if I buy a couple of tickets, and then I'll just get that extra bonus if I win the $2,000 in the end.
Yeah, to chime in, I would also go with the same option as Oliver. I know like raffles are based off of pure luck, so it wouldn't be smart to invest all your money into that. But, you know, why not? You always have the chance of winning.
Yeah, me personally, I'm choosing A. I'm just going to spend as much money as I can on raffle tickets because I am winning that $2K. I don't care if I spend $100 on it.
All right, listeners, which one did you pick? It looks like Matt picked option A, which means that he's a highly aggressive risk taker. If you picked B, then you're going safe. and not going for any risk. And if you pick C, like Oliver and Krish, then you're a moderate risk taker.
Thank you so much for tuning in to the Money Smarts for Kids podcast. Make sure to tune in to our next episode so that you can learn about budgeting and save enough money to buy some of those raffle tickets.